Comprehensive Analysis of DigiAsia Corp. FAAS. Through Warren Buffett's investment lens, one business quality and economic moat analysis. DigiAsia Corp. Nasdaq. FAAS operates as a fintech-as-a-service FaaS provider in Indonesia and emerging markets, offering embedded financial solutions through a business-to-business 2x model. The company provides a comprehensive suite of financial services including digital wallets, QR payments, remittances, card issuance, and banking infrastructure through API integrations. Recently, the company has shifted strategy from a super app approach to a focused, simple app strategy that emphasizes core financial transactions and embedded wallet services for third-party platforms. 1.1 Revenue Model and Business Operations. DigiAsia generates revenue through multiple streams: transaction fees, revenue from payment processing, digital wallet transactions, and remittance services API licensing fees. Fees from enterprises and financial institutions accessing DigiAsia's financial infrastructure. SaaS subscriptions, revenue from software solutions for loyalty programs, analytics and revenue optimization. White label services, fees for providing branded financial services to corporate clients. The company has developed several key products including CashPro AI-powered e-money services, Remit Pro remittance services, and DigiAsia digital financial services in rural areas. Recently, DigiAsia launched an AI-powered contextual intelligence engine that analyzes transaction patterns and behavioral signals to deliver personalized financial offers in real time. 1.2 Competitive Advantages and Economic Moat. First mover advantage. DigiAsia positions itself as among the first embedded fintech service companies in Indonesia. It's providing early market entry benefits. Regulatory licenses. The company operates with multiple financial licenses from Bank Indonesia, including approvals for e-money services and remittances, creating regulatory barriers to entry. Technology platform. DigiAsia's API-driven infrastructure allows for rapid integration with partners, creating switching costs through embedded workflows. AI and data advantages. The company's new contextual intelligence engine leverages machine learning from transaction data, potentially creating a data network effect as more transactions improve AI capabilities. However, according to Morningstar's quantitative assessment, DigiAsia lacks an economic moat. Economic moat, RBLMQ. The company operates in a highly competitive fintech landscape with limited proprietary technology protection and faces competition from both traditional financial institutions and technology giants entering the fintech space. Table. DigiAsia's economic moat assessment using Buffett's framework. Moat component. DigiAsia status assessment. Brand value. Limited recognition beyond Indonesia week. Regulatory advantage. Multiple financial licenses from Bank Indonesia. Moderate switching costs. API integration creates some customer stickiness. Moderate. Network effects. Emerging data advantages from transaction volume. Developing cost advantage. Limited scale compared to global competitors. Weak. To management quality assessment. Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. DigiAsia's leadership team demonstrates several characteristics that align with Buffett's preferences. Though some aspects warrant concern, its leadership experience. The company is led by co-CEOs Prashant Gokarn and Alexander Russley, who have backgrounds in financial services and technology. The board includes experienced members such as Ken Summer, former CEO and CFO of Visa, and Rudy Antara, former Indonesian Minister of Communication and Informatics, providing industry and regulatory expertise, strategic decision-making. Management has demonstrated adaptability by pivoting from a super app strategy to a focused, simple app approach based on user behavior data. The company has also made forward-looking investments in AI technology, launching the contextual intelligence engine to improve cross-selling and user engagement. Capital allocation. Capital allocation management has approved a controversial treasury strategy to allocate up to 50% of future profits to cryptocurrency holdings. This approach represents a significant deviation from traditional corporate treasury management and introduces substantial volatility risk. Shareholder alignment. The management's recent decision to voluntarily delist from Nasdaq raises concerns about shareholder alignment. The company cited high listing costs and challenging capital market conditions as reasons for delisting. But this move significantly reduces transparency and liquidity for public shareholders. Transparency and communication. While the company provides regular press releases, it has struggled with financial reporting timelines, missing the September 15, 2025 deadline for filing Form 10-F. This lack of regulatory compliance would likely concern Buffett, who values transparent and timely financial disclosure. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. DigiAsia's financial profile presents a mixed picture when evaluated through these lenses. 3.1 Revenue growth and profitability. DigiAsia has demonstrated strong revenue growth, but continues to struggle with profitability. Revenue growth. The company reported $51.1 million in revenue for 1H 2024, representing 45% year-over-year growth from $35.3 million in 1H 2023. Net loss. The company reduced its net loss to $1.48 million in 1H 2024, improving 59% from $3.68 million in 1H 2023. Profit margins. While specific margin data isn't provided, the continuing net losses suggest the company has not yet achieved sustainable profitability. 3.2 Return on equity and invested capital. Buffett places great emphasis on return on equity (ROE) and return on invested capital (ROIC) as measures of management's ability to generate value from shareholder capital. Return on equity. Normalized -13.76%, indicating value destruction rather than creation. Return on invested capital. Normalized -12.17%, failing to meet cost of capital. Return on assets. Normalized -11.24%, inefficient use of assets. These figures fall dramatically below Buffett's typical threshold of 15% plus for attractive businesses and indicate poor capital efficiency. 3.3 Debt levels and financial health from a balance sheet perspective. DigiAsia shows some concerning metrics. Liquidity position. Quick ratio of 0.73 and current ratio of 0.79. Indicating potential short-term liquidity constraints. Interest coverage, -2.48. Indicating inability to service debt from operating earnings. Cash position. The company has not disclosed specific cash balances, but the low liquidity ratios suggest limited cash reserves. 3.4 Free cash flow generation. Specific free cash flow figures are not provided in the search results. However, the company has negative profitability and interest coverage issues, which suggest weak cash flow generation relative to its operational needs. Table. DigiAsia Financial Health Assessment 2024. Financial metric status. Buffett. Standard assessment. Revenue growth 45%. 1H 2024 YoY. Consistent growth, good profit margins, negative improving, consistently profitable, poor ROE. Normalized, -13.76%, 15% plus, very poor. ROIC, normalized -12.17%, 15% plus, very poor. Liquidity quick ratio, 0.73, strong liquidity, poor interest coverage, -2.485x, very poor. For intrinsic value estimation. Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life rather than prevailing market prices. Estimating DigiAsia's intrinsic value presents challenges due to its inconsistent financial performance and the pending delisting. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to DigiAsia is challenging due to limited financial history. Only limited financial data is available. Negative earnings. The company's lack of profitability makes cash flow projections highly uncertain. Pending delisting. The voluntary delisting from NASDAQ adds significant uncertainty to future valuation. Morningstar's quantitative model suggests a fair value of $1.64 per share, which would represent a 258% premium to the current price of 9 cents. However, this model carries a very high uncertainty rating. 4.2 Relative valuation metrics. DigiAsia's current valuation multiples are challenging to interpret. Market capitalization. $5.47 million, which is exceptionally small for a public company. Trading multiples. Price sales, PE. And other multiples are not calculable or meaningful due to the company's negative earnings and unusual market position. 4.3 Acquisition value perspective. The company has received a firm offer from Moat Valuing DigiAsia at $400 million, including a $25 million cash component with the remainder in stock. This potential acquisition value of approximately $6.59 per share represents a significant premium to the current market price, but is contingent on deal completion. 4.4 Valuation challenges and considerations. Valuing DigiAsia requires acknowledging several critical problems. Going concern risk. The voluntary delisting and financial challenges raise questions about viability. Limited financial disclosure. Missing financial reporting deadlines reduces transparency. Cryptocurrency strategy. The plan to allocate 50% of future profits to cryptocurrency introduces substantial volatility and risk. Based on available data, DigiAsia appears significantly undervalued based on acquisition offer, but fairly valued or overvalued based on fundamental earnings, power, and financial metrics. 5 Long-term prospects and risks. Evaluating DigiAsia's long-term potential requires examining industry dynamics, competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The Indonesian fintech market presents substantial opportunities. Financial inclusion. Indonesia has a large unbanked and underbanked population, creating opportunities for digital financial services, digital payments growth. The digital payments market in Indonesia is expected to grow at a compound annual growth rate CAGR of 15 to 20% over the next decade. Regulatory support. Bank Indonesia has been supportive of fintech innovation while implementing appropriate safeguards. DigiAsia is positioned to benefit from these trends through its embedded finance approach and regulatory licenses. 5.2 Competitive threats and market position. DigiAsia faces competition from several fronts. Local fintech companies. Numerous Indonesian fintech startups targeting similar opportunities. Global technology companies. Large tech companies entering the financial services space. Traditional banks. Indonesian banks developing their own digital offerings. DigiAsia's competitive position appears challenged due to its small scale, limited resources, and lack of clear competitive advantages. 5.3 Key risks and challenges. Several risks could impact DigiAsia's ability to compound capital over the long term. Delisting impact. Voluntary Nasdaq delisting reduces transparency and liquidity. Profitability challenges. Continued inability to achieve sustainable profitability. Cryptocurrency volatility. The treasury allocation to cryptocurrency introduces significant risk. Successful implementation. Successful implementation of the simple app strategy is not guaranteed. Regulatory changes. Evolving financial regulations in Indonesia could impact operations. 5.4 Capital compounding potential. For DigiAsia to compound capital effectively over the next decade, several conditions must be met. The company must achieve sustainable profitability and positive cash flows. The acquisition by Moat must be completed successfully. Management must demonstrate disciplined capital allocation without excessive cryptocurrency exposure. The company must successfully navigate the delisting process while maintaining shareholder value. If these conditions are met, DigiAsia has the potential to benefit from the growing Indonesian fintech market. However, the uncertainty around these factors makes the company's long-term prospects highly speculative. 6 Final verdict. Buffett-style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how DigiAsia Corp measures up against each of the key criteria. A. Understandable business. DigiAsia operates in the fintech sector, which is reasonably understandable. However, the complexity of their API-driven model and cryptocurrency strategy adds some opacity. Rating. B. Consistent earnings. DigiAsia has demonstrated revenue growth, but inconsistent profitability, with continued net losses despite improvement. Rating. Poor C. Good ROIC. DigiAsia, SRO of minus 13.76%, NE, and ROIC of minus 12.17% fall dramatically below Buffett's typical threshold of 15% plus. Rating very poor. D. Low debt. The company's interest coverage ratio of minus 2.48 indicates inability to service debt. And liquidity ratios are concerning. Rating very poor. E. Attractive valuation. The stock appears statistically cheap but may not be truly undervalued given profitability challenges and delisting risks. The acquisition offer provides potential value but is uncertain. Rating poor. F. Long-term moat. DigiAsia lacks a durable economic moat, according to Morningstar's assessment. With no sustainable competitive advantages. Rating very poor. 6.1 overall assessment. DigiAsia Corp does not meet most of Warren Buffett's investment criteria and would not qualify as a Buffett-style investment. While the company operates in an attractive market and has demonstrated revenue growth, the lack of consistent earnings, poor returns on capital, weak economic moat, and financial challenges make it completely unsuitable for a traditional Buffett-style investment approach. The company might be appropriate only for speculative investors who believe in the TDA, acquisition potential, or can tolerate extremely high risk. Buffett would undoubtedly avoid this investment due to its lack of profitability, uncertain competitive position, and financial instability. For those interested in the fintech sector through a Buffett lens, significantly more suitable candidates would include companies with long track records of profitability, strong economic moats, predictable cash flows, though these would need to be evaluated based on their own merits against Buffett's criteria. Tabled DigiAsia Corp Buffett-style investment suitability summary. Criterion assessment explanation: understandable business, marginal fintech business, understandable but with complex elements. Consistent earnings, poor revenue growth, but inconsistent profitability. Good ROE. ROIC very poor ROE, minus 13.76%. ROIC, minus 12.17%, destroying value. Low debt, very poor interest coverage, minus 2.48. Poor liquidity ratios. Attractive valuation, poor statistical cheapness may reflect fundamental problems. Long-term moat, very poor, no durable competitive advantages per Morningstar. Overall suitability not recommended, fails most key criteria for Buffett-style investment.